Jim Pearce, Chief Investment Strategist for Personal Finance, with a weekly update on Friday, May 3rd, 2024. After last week's hot personal consumption expenditures report, the Federal Open Market Committee decided this week to leave its policy rate unchanged. According to Fed Chair Jerome Powell, the committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably towards 2%. So here's the official statement that they released, and that quote's in the body of this. And then in the press release afterwards was really where the surprise was. Powell also made the statement later that it is unlikely the next policy move will be a hike. Those words are meant to reassure Wall Street that the recent rise in inflation has not fundamentally altered the Fed's long-term outlook on monetary policy. However, the mere fact that Powell even addressed the possibility of a rate hike illustrates how much the inflation picture has changed since the start of this year. Until a few months ago, the only question was how soon the Fed would start cutting interest rates. Now, it's not clear if the Fed will cut them at all this year. As I said last week, that is not necessarily a problem since the consumer is still spending and most companies are meeting or exceeding their guidance for first quarter performance. So long as those two conditions remain in place, the stock market should be able to avoid a steep sell-off. In fact, the S&P 500 index has gained ground over the past 2 weeks. The index is about 5% below its all-time high achieved in March. Now here's a chart, by the way, I'm showing you the S&P 500 during the past year. But if we go year to date, you can see the peak over here in late March, and then a pretty big dip here that bottomed out about 2-3 weeks ago. And since then, and granted, it's too soon to call this a trend, but the S&P 500 is higher now than it was then, even after its sell-off earlier this week after Powell's comments. Its drop over the past 2 weeks looks a lot like the decline that started last summer and lasted through the fall, after which it rallied strong. So if we zoom back out to a year, here's the peak last summer in late July, and it kind of, and the Fed kept cutting rates, and then Powell made some hawkish statements at the Jackson Hole conference. Then there was the big sell-off. But once the inflation numbers started coming down and we got a good read on GDP for the third quarter, suddenly, and you can see the stock market really spiked up from about, let's call it November 1st, pretty much all the way through April 1st. So a good, let's call it 6-month rally there. I expect something like that to happen this year. We may see no net gain index during the second quarter while the Fed waits for inflation to cool off. But once that happens, we could see a quick pop in anticipation of an interest rate cut during the third quarter. So keep in mind, this decline here lasted 3 or 4 months. It very quickly made up for that lost ground. So we're only, even if it turns out we're still in a decline, we're still only maybe 4 weeks into it. So if this one's as long as the last one, we may have essentially a couple more months of the market trundling lower before it gets ready for its next leg up. That appears to be a scenario that Wall Street is banking on. The bond market agrees, with the yield on the 5-year Treasury note falling below 4.5% this morning after rising above 4.7% last week. So here's the yield on the 5-year Treasury note going back 1 year. Now, I know I normally show you the 10-year note, but the 5-year is more sensitive to the near-term change in interest rates. So again, interest rate on the 5-year peaked at about the same time the stock market was bottoming out, then rates came down as the stock market went up. So this is kind of the mirror image of that last chart we looked at. Here's the S&P 500 over 1 year, here's the 5-year. But again, if we come back in, let's say year to date, you see a peak in the rate here just, 3, 4, 5 days ago. And now it looks like a nice little jab down. Also, the CBOE volatility index, or fear index, has fallen 25% over the past 2 weeks. And lower is better, by the way. The higher the VIX, in theory, the more fear there is, because the CBOE volatility index essentially is a ratio of short-term put contracts on the S&P 500 index versus call options. And of course, put options go up in price when the value of the underlying security goes down. So you can see how high this was. And this is April 15th, where I got the crosshairs right now, and it's above 19. Here we are on May 3rd, and it's below 14. If we go back out a year to give you some context, it's been higher than that before, especially in October when the stock market was bottoming out. But this big spike here in April, was very noticeable. But we're already now below that, and we're actually, the VIX is back down to where it was. You can go all the way back here to December, so that's a good sign too. In short, what panic there may have been in the stock market has been placated, at least for now. Powell's words had the desired effect of giving no encouragement for an immediate rate cut, while making clear he is not contemplating raising them anytime soon either. Sometimes no news is good news. The stock market has come a long way over the past 6 months. So has the economy. A little consolidation is in order, after which a little good news could get things going again. That's this week's PF Update, and I look forward to talking to you in another week.